For much of the last year and a half, the crypto market has been on easy mode. The easy mode has led to gains in certain currencies with falls in others. However, this easy mode is expected to make way for hard times in the future. Crypto traders are expecting bearish trends in 2022, and the patience and resilience of all investors will be tested. So with the crypto winter being here to maybe stay for a long time, nobody really knows, your investment approach might have to change to make a sizable return on your crypto investments. As we're no longer in the up-only era of crypto, we have to plan for the inevitable bear markets. Now, bearish markets can offer the best opportunity to our investors to plan just how well they can perform in the next bull market. So in this video, we're going to take a look at some of the tips to survive the crypto bear market and perhaps even make a sizable profit yourself. Let's dive straight in. Tip number 1 is dollar cost averaging. You may have heard this term before, where investors will pile in money every day, week, or month, no matter the market conditions. Dollar cost averaging can be used to spread purchases periodically across different dates to reduce the volatility that the purchase of the asset might have. For example, if you wanted to buy Bitcoin at 65K, instead of putting 100% of your money in at 65K, you might have put in maybe 10% of it at 65K, and then rode the roller coaster ride down to 55K, put in another 10% there, even more at 45K, 35K, etc. Some experts agree that with dollar cost averaging, the potential to take your savings in the crypto market. Daniel Polatsky, founder of Bitcoin ATM and financial services firm CoinFlip, says it's a great strategy and it should be applied to something that you believe in. Just don't put all your eggs in one basket. You should still diversify your wealth in case your decisions are not correct. If you put a certain amount of money in Bitcoin every single week since 2010, you'd be one happy person right now. If you did it over the last year today, you may not be happy, but maybe in a few months, you would be incredibly happy, says Ron Levy, CEO of the crypto company. Strategy number 2, stablecoin yield farming. As a trader, the best way for you to play current market conditions and get the best outcome possible out of your investment is to invest, possibly, in stablecoins. Now, investors can diversify your investments and spread them across different stablecoins for a better return. For example, you can go to PancakeSwap Finance and drop in some liquidity pool tokens for some stable APR in a decentralized finance way. If you want even more percentage, you can go to a crypto lending platform like Celsius Network. You can deposit your stablecoins in a crypto lending platform like Gemini Earn or Crypto.com. If you want to go an even more decentralized route, you might want to go with UST in the Anchor protocol, which is now currently earning a 19.5%. However, it does carry its own risks as well. So whatever platform you decide, stablecoins can earn some decent income in a more passive and stable way. The third strategy, cash is king. There is no alternative to cash on your side. It's always good to have some cash on you, even a small percentage, so that you can further your investments with time. Cash on the side means that you have more reserves available if things don't go to plan. And when you have cash, you might want to consider diversifying your purchases a little bit if you're a little less risky. Strategy number 4, avoid the falling knives. Now, you may be tempted to invest in falling knives, but this might not be a good idea. Crypto tokens that are already on a downtrend may not be ideal for investment purposes. You might be hungry for significant gains through volatile upward movements, but should be aware that falling knives can turn your portfolio even redder. For example, when Elon Musk was pumping up Dogecoin, you might have thought that Dogecoin was a good investment. So if you invested in Dogecoin when it was at its lowest point last year, this year, well, you'd be a pretty sad dog. So yeah, if you think a coin can drop no further down and you're at the exact bottom, you might be wrong. So try to avoid catching those falling knives. However, you could be right in the off chance and make a lot of money. The next strategy is to take profits early. Now, if you're a daily trader or weekly trader, you will want to cash out in every window of opportunity that presents itself to you. But if you're a long-term hodler, maybe you want to consider taking profits early. For example, if you bought Bitcoin when it was trending upwards around the 20 to 30K range, and then it jumped up to 65K, you might have wanted to take some profits in between there. If you listened instead to everyone who advised you to hodl your Bitcoin forever, and when Bitcoin crashed from 65K down to the 30s, then you might be a little bit upset by that. So if there's anything that we learned last year in crypto trading, it's to take some profits early. You might also want to consider taxes too, because taxes does affect your trading, especially if you live in the great old land of America. Bear market strategy number 6. Stop checking your portfolio every hour, or minute, or second. Now, checking your portfolio every hour is only going to bring more anxiety and create unnecessary panic. A lot of new investors are guilty of checking their investments after every hour and then creating panic at the slightest sign of a fall. This approach will just make you more sad every single time you check your portfolio, which is probably going to become more redder during a bear market. A better approach to follow is to routinely check your portfolio. Set a timer, say every 3 days, and this will help you keep tabs on the updates within the market and save you from unnecessary stress in the long run. The same goes for a bull market. If you're prone to checking your portfolio every hour during a bull market, you might be victim to falling for this trap. So don't do that. The next strategy is to actually buy the dip. Now, people might be so scared during a bear market that they don't actually deploy any of their cash. They just wait and wait and wait until they think that Bitcoin's going to go to $0, which it probably won't. So they never end up buying at all. Now, the phrase buy the dip comes when you actually buy low. Because if you think about it, when a cryptocurrency or any asset really is at a low price, the chances of it going higher is much more likely than it going lower. And the reverse is also true. If a price of an asset is already super high, there's more downside risk. So during a bear market, there's greater opportunity, which means you should probably buy the dip at some point or another. The next strategy is don't throw your gains back. If you are one of the lucky investors to make a gain during crypto winners, then you probably shouldn't throw your gains back into the market. The market may treat you well once, but there is no guarantee that it will treat you well twice. A number of people have lost their gains after they pumped their profits back into a bear market by blindly investing in anything. Now, this is a logical gambler's fallacy because you basically think that if you win once, you're more lucky in the long run, and if you keep losing, then you're going to be doomed forever. The truth is that lucky people don't always face luck all the time. It's just a matter of, well, luck. Strategy number 9, don't time the bottom. Now, there was only one Nostradamus and he's long dead. You cannot time the bottom of crypto coins, so it's hard to tell if you're really buying at the bottom or you're just holding a sharp knife. Rather than buying at the bottom, wait for the crypto to become steady, or better yet, show signs of improvement before you buy it. Remember to be timely with your investments, and patience is key. Number 10, take your losses. As a crypto investor, you cannot negate the chance of a loss. Losses are part and parcel of the game and can't be avoided by any means, unless you're a crypto god. You should look to curtail your emotions and solidify your minor losses before they turn into major losses. This is where setting stop losses in place can actually help you, unless there's a flash crash that's never been seen before and it blows right past your stop loss. Well, in that case, then good luck. Now, bonus tip number 11. Don't copy crypto influencers. Now, there are a number of crypto influencers around today, and many of them are basically just being paid and shilled by other people. So yeah, it's probably not a good idea to follow their strategies because crypto influencers probably just are in it for the money and don't care about your money. So guys, I hope you had a little bit of insight into some of these bear market strategies. If I left out a strategy that you have in mind, please share it in the comments below and let others know of some strategies that we can all use during this hard time in crypto. As always, guys, stay safe in the DeFi space and have an amazing day.